You've done the analysis, you've marked your levels, you've hit the buy button, and suddenly the trade turns against you. And instead of cutting it for a loss, you hold on, hoping it comes back. Look, we've all been there, staring at a screen, watching weeks of disciplined profit vanish in a single emotional trade. But what if I told you that the secret to never blowing another account has absolutely nothing to do with finding the perfect entry? Welcome to Price Plan Profit, where we trade with structure. Most new traders spend 99% of their time looking for magic indicators or the perfect setup. They're chasing the hype, but professional traders, we obsess over one boring mathematical rule: position sizing. When you trade with structure, emotions disappear. Let's look at the math. If you have a $10,000 account and you strictly limit your risk to 1% per trade, for instance, you would have to lose 100 trades in a row to blow your account. 100. Let that sink in. Let's get into some actual numbers. Now, this is only a formula that I'm going to talk about with equity trades. All right, let's take your account risk, divide it by the trade risk. That is going to equal your position size. So, if you have a $50,000 retirement account and you're wanting to risk 1% per trade, then your maximum loss on equity is $500. Now, let's say that you're looking at a stock and your demand zone is $2 from your entry. That's where your stop would be. You would take that $500 max loss, divide it by the $2 stop loss, and boom, you can buy exactly 250 shares. Not 300 because you feel confident, and not 100 because you're scared. 250. That's how you take back control. What if you're an options trader? It might feel like it would be more complicated, but honestly, it's not. I have one simple rule. I never risk more on an options trade than what I'm willing to go to zero. Now, I do not take max loss on my trades, but you never know. When you're in an option, they can be worth zero before your stop is ever hit. That's why I have a hard rule that I know what my max loss per trade is, and I never have more than that max loss at risk at any one time on my options trades. So math is great, but what does it look like on a live chart? You see, this is where risk management meets market structure. I never just place a stop randomly to fit some arbitrary percentage rule or dollar amount rule. I want to find the structural level, like a clear demand zone or a clear supply zone, and I'm going to place my stop safely below the demand zone or safely above the supply zone. The distance between my entry and this structural invalidation point or my stop is what dictates my math. If the stop is wider, then I'm going to buy fewer shares if I'm trading equity. The risk stays exactly the same. Position sizing is your shield. It keeps you in the game. But market structure, that is your sword. You can have the best risk management in the world, but if you don't know where the true institutional supply and demand levels are, you'll just suffer a slow death by 1,000 cuts. If you are serious about building discipline and finally understanding the why behind price movement, me and Trendy John are hosting a live deep dive supply and demand class later in March. We're actually going to have a webinar about it on March 11th and March 18th. We're going to cover exactly what supply and demand trading is and how supply and demand trading has evolved in 2026. There is a link in the description below. Be sure and secure your spot. I look forward to seeing you in the next video.